Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds.
All right, Cole, our lacrosse player you're in New England, right? New York, right? Upstate New York?
Yep.
You go to Union, is that right?
Yes.
And you hurt your knee over the summer, or actually last season, right? And had some major surgery. How's your rehab coming?
It's coming along really well. Started running for the first time, so making good steps.
And with rehab, you got to stick with it, right? You got to do a little bit every day. Otherwise, you don't get back certainly to premier college scholastic A-level playing shape without doing your rehab, right?
Definitely true.
And trading's a lot like that. You got to sometimes the market is really kind of tough, and I would call the market right now really kind of tough. It's and you're going to see a bunch of mixed signals. We're going to try to tackle the market forecast indicator, and I know that you just got a practice TD Ameritrade account, so I'm going to also show you how to set it up on your platform. And for those of you playing the home game, you don't have to have a TD Ameritrade account, but the market forecast indicator, which is factors 7, 8, 9, and 10 on cheat sheets, basically the interplay between those four different time frames, and I'll explain what an oscillator is in a minute. That really does drive some of the better trading signals on the cheat sheet platform. So you can always just use cheat sheets sort of to drive your timing, or just accept the buy the dip signals as they come, or the intermediate progression signals that I'll walk you through. But I always like to have the factual data backup. And so that's why we're going to spend the time looking at those four factors in chart form. And I did, just before we started the broadcast today, I set up a intraday update. So we'll look at markets, sectors, subsectors. Everything has been updated as of just a few minutes before 1 o'clock Eastern time, about 3 hours before the close. So let me share my desktop. And I'm sorry for the little vortex of death that you're going to see here. It makes everyone a little dizzy. Let me know when you can see it, and I'll move off of it.
Yep, I can see it.
All right, there it is. So we're going to go over to our TD Ameritrade platform to start with. And just very quickly, Cole, let's take a look at the market. And what I've got is the market forecast indicator up here, and I'm going to show you how to put it on the charts. So let me just start out with the SPX. We've been in rally mode here, even though we're overall, well, you tell me, is the market in over several month period? Are we making new highs? And are we in an uptrend? Or in your opinion, are we going sideways on the kind of the monthly time frame here, or are we going down?
It kind of looks like we're still hitting lower lows, although recently the low is higher. So I guess, but the higher highs haven't been coming in quite yet, it looks like.
Yeah, it's listen, this is what makes it tough, because obviously it depends on the time frame. The time frame that's the longest here, where we're tracking sort of on a monthly basis, the market makes a series of lower highs.
Yeah.
There's been three major lower peaks after bear market rallies, and that's what makes bear markets tough, because it can really feel like the bulls are back in charge, and it can last for weeks, if not months. This last one lasted months. And so a lot of us, we lick our chops when the market reverses at a key level like it did here. We load it up on shorts, and then, things are working out. We're buying back some of those shorts and making profits, and we keep, adding more shorts on. But then eventually the market is going to reverse, and that's what's happening right now. We're going through a pretty rip-roaring high 3-day market rally. And I would tell you there is some signs in the market forecast here today that if they hold into the close, will, I would say, give us better odds than not of continuing to move higher and possibly testing this diagonal downtrend up here. And I'll explain that in a minute. Before we get into that, I'll tell you that this what we're seeing right now here, this big leg down followed by a few days legs up, that often happens after a major moving average cross. So this is the 10-period moving average. Remember, we talked about this last week. This is the 10-day moving average in green. and this is the red 40-day moving average. And when those two moving averages cross over and green is above red, we say the market is in an intermediate uptrend. So it's the days to weeks sort of trend that I like to trade in. And so a few days ago, we actually, late last week, we actually crossed back down. So this intermediate trend ended. There's a bearish moving average cross. And when that happens, oftentimes price will come back and retest. It will sort of push back to the 40-day moving average after a bearish crossover. So it can kind of make you squeamish and nervous. But more often than not, we'd roll over and go down from here. However, the market forecast, which is this set of indicators here that we're going to spend a lot of time on today, is perhaps telling us that this 3-day rally might turn into something more. And that's what we're going to talk about today. So are you with me so far?
I am.
Okay. So the market forecast on cheat sheets, it's factors 7, 8, 9, and 10. And I pulled just before we started the day today. I'm going to start by showing our indexes. I pulled an update of market conditions right now. And here's the SPY. And the SPY is actually, the tailwind score is not very good. And that's because we're in a downtrend on the long-term time horizon. That's the 10-week moving average is below the 40-week moving average. And the intermediate trend, which we just showed you, turned bearish because the 10-day moving average is below the 40-day moving average. We're in a short-term uptrend. That's the 10-hour moving average is above the 40-hour moving average. And then we have this series of more bullish than not oscillators, all in agreement that as of right now are telling us that the long, intermediate, near-term, and momentum timeframes of the market forecast indicator are actually suggesting that we shouldn't be too bearish. Now, this is a forecast. This is the reality over here. The reality is saying we have mixed signals. These 4 indicators, at least as of right now, the way they're aligned is that they are projecting, based on the trading activity that's taken place through midday today, they're projecting and extrapolating that we probably will see a little bit more upside if these were to hold into the close. So that's the first thing I wanted to mention is that these indicators, and particularly the shorter term indicators, the momentum line and the near term line, that's the blue and the red line on the chart over here, this blue line and this red line. These have a tendency to move around a lot. And so it's really important to only act on these signals, especially in the shorter time frames, toward the end of the trading day. There's an old adage in trading that most of what happens that matters, institutions control most of the money and they are the market. They basically hold off until the very last part of the trading day to place their bets. And so really the last hour of trading is the time to take these indicators most seriously. Okay.
Makes sense. So none of the factors 7 through 10 don't have anything to do with the moving average lines.
They don't. No, these factors 7 and 10 have to do with these lines here. And let me explain what each of these signifies. So we'll start with the longest term forecast line. And by forecast, what I mean is that these are what we call oscillators. They're the formula for these 4 happens to be proprietary. It's something that TD Ameritrade does not share. But we know, based on the way other oscillators work, that they're essentially a momentum gauge. Think of it like an accelerator, a gauge of your acceleration. So you've got your speedometer, and then a lot of cars will have like tachometers, which kind of show you how fast your tires are increasing their rotation. Okay, and that's really what these things are telling us in different time frames. They're not about the speed of price. It's more about the acceleration of price. And obviously, if price is accelerating, then we can assume that more often than not, the velocity of price will at least probably not reverse when you are accelerating, right? It's kind of hard to go backwards when your speedometer is increasing. The rate of change of the speedometer is increasing. So
Right.
that's what we look at when we refer to these oscillators. And these 4 oscillators are all part of one indicator, which is called the market forecast. And it's how these 4 acceleration oscillators interact with one another that can really give us a sense of what's going on. And I'll tell you, they're most useful when you're hearing a lot of either doom and gloom or overly exuberant chatter in the press and on trading blogs. You know, a lot of people have their own agenda and they try to influence each other because they want a certain outcome and they try to influence the market, especially big money institutions. They've got big research departments with reputations on the line. They like to what's called talk their book. They may be long in certain sectors or stocks within a market, and and it's in their interest to give as rosy a forecast as possible and to express as much conviction in their positions as possible because they want to influence others. And the more people they can influence to go along with their idea, the better it is for them. So sometimes you have to distance yourself from the propaganda. And one of the ways to do that is to be steely-eyed and objective about what you're seeing. So for example, Cole, right now, I'll tell you that I feel pretty bearish about the market, but I will also tell you that I've lost more money based on my feelings trading than anything else, other than not practicing good risk management, which will be another whole hour for another day. So when I look at the way the oscillators are interacting with each other right now, the way it looks to me is that our offense is about to take the field. I'm going to use a football analogy. The ball has changed possession. We're no longer defending. We're taking over on offense. That's the good news. The bad news is that based on where this green line is, it'll be like taking over on downs at our own 1-yard line. So good news, we've got the ball. Bad news, 99 yards to go, right?
Yeah.
And so let's get into why I think that.
Yep.
Let's start with the 4 time frames. So factor 7 we refer to as, you'll hear it referred to a couple of different ways, the long-term market forecast indicator, or what's called market sentiment. That's actually how you'll see it in TD Ameritrade. So this time frame gauges acceleration, price acceleration on a months to years sort of basis. So on average, the yellow line makes a cycle, goes up and comes back down approximately every 9 months. But there's a lot of room within that time frame for that signal to operate. So when we say months to years, the longest I think I've ever seen it take to gyrate in kind of one direction before reversing is about 2 years. And the shortest time frame is perhaps maybe 4 or 5 months, with 9 months being typical. Okay, so we'll use 9 months as sort of our long-term gauge. And so what I mean is that the time frame we're interested in here is really longer, the longest term time frame that we would care about, and actually one time frame above the time frame I'm most comfortable trading in. So it's months to years, a year or two, 9 months, 5 months, something like that. Okay,
Got it.
so market sentiment. This is what we would describe as the path of least resistance. So when the market sentiment is rising, particularly when it's above 50, like it is right now,
Yeah.
we're bullish, and the path of least resistance is higher, even though price can spend weeks at a time going in the opposite direction. It just simply means that in the longest term time frame, at least at the moment, the way this oscillator is reading, that the path of least resistance is higher, and the risk that overwhelmingly the risk is not to the downside but to the upside based upon the way this indicator reads right now. And I'll get into how to read it in a minute. Okay.
Okay.
So the next time frame down is going to be a factor 8 on cheat sheets, and that is the intermediate time frame. And this is the one that most of the trading that I do directionally is based on. And so this is what we'd call the weeks to months time frame. So in general, I would say that on average, this would be a 4 to 12 week oscillator. And again, what I mean by that is when it's bullish, it can take approximately a month to 3 months to move higher before trend breaks. Sometimes it doesn't work out, but in general, when things are going well, it will spend more time, the market will spend more time going up when this green line is pointing up or in what we call the upper reversal zone here. All right, so green line, intermediate time frame, weeks to a couple of months, 3 months, 1 month, somewhere in that range, okay? Next up are what I like to, so these are what we refer to as the senior time frames. You'll hear me say that a lot. So things that are, these are trends governed by acceleration that's in the weeks to months to years category. So senior time frames, intermediate and long-term or market sentiment, okay? So green and mustard color are our longer term oscillators, senior time frames. Got it?
Got it.
Junior time frames would be the blue and the red lines. And the blue line would be next. It would be one trend, kind of one level down from the green line time frame, which is the intermediate time frame. And we call this the near-term line. And near-term would express approximately a couple of weeks. That's about what this one does. It tends to cycle every 10 to 20 trading days. So a couple of weeks on average, 14 days, 20 days, something like that. So it is
that factor 9?
Yeah, that's factor 9. Very good. Yep. Factor 9, near term. And then the shortest time frame is the momentum line. So think of the blue line as sort of what we call a swing trading time frame. So from the bottom to the top here, it's generally one market swing in one direction. You see that? We go from where I'm pointing, the lowest point to the highest point. Lasts about, you can see this one only lasted, maybe 6, 7, 8 trading days. Here would be another one. This one lasted a little longer, from low to high. But so we're talking about kind of a swing, just kind of one leg up. All right. Whereas the green line is more about a series of legs up. You see that? See how the green line here is kind of capturing a couple of these blue line swings. It's not perfect, but that's the way to think of it.
Got it.
And then the yellow line, when it's going up, there can be a number of green line cycles up and down. Generally, when we're going really well and the gold time frame is really bullish, there can be 3 sort of bullish intermediate cycles held within that longer term time frame. And when things are going really, really well on the intermediate basis, and we're moving up. We're moving up pretty constantly. There can be 3 solid kind of blue line cycles within the context of one green line wave up. Now we get to the shortest term time frame, and that is called the momentum timeline. It is probably the least important to us in terms of making our forecast, but it can be crucial in confirming or negating things in the very short term. So we call this the momentum timeline, and this is 1 to 3 days. It's short in, short out. This is when day traders take advantage of a small move in the market, and they're out by the end of the day, or they're out by no more than a couple of days of trading. They just want to take advantage of a very short-term move in the market and get out. Like this would be a good example right here. Yep. 1, 2, 3. This line is already rolling over. Do you see this red line here?
Yeah.
Red line kind of corresponding with this little mini leg up. And you'll see how it's rolling over here, which means the momentum, price is still going up, right? Price hasn't been affected yet, but the pace at which price is going up sort of slowed down here. And you can see that, right? We made our big move. The big ascent here is through these first 2 days. And then as we build into day 3 here in mid-afternoon on the final day of a 3-day leg up, we're slowing down and the momentum line is rolling over. Now, this could change, right? Before the end of the trading day, more buyers could come in and we could see this move up. But as of right now, it looks like we're going to put in a slightly lower peak on the momentum side of things and a slightly higher peak on the near term side of things. So that's the way it's looking right now. So why am I somewhat cautiously more optimistic? Because there's really two ways this could play out, right? We're in a short-term downtrend. We're in a long-term downtrend, but we're also in a short-term downtrend, right? Short-term, we're making, there's a low, there is a lower high, right, compared to this one.
Mm-hmm.
There's another low that would be a lower low compared to this one, right?
Mm-hmm.
And then this is another high. We haven't confirmed the high point yet, but if it were to roll over today, this would be yet another lower high, right?
Right.
So short term, even though we've gone up the last 3 days, we're in a, maybe when I say short term, I mean near term. Sort of the blue line time frame is sort of we're in a little bit of a pullback here, but we're making a run to change that. And one of the things I like to do is draw a little diagonal line on the shortest term trend to sort of indicate where the line in the sand is, and we're right there, right? So here's the 40-day moving average. Here's this little, what we call diagonal resistance, just sort of a diagonal line that connects a few different price bars. So we're at here a couple hours before the close. We're kind of at a key level. So where could we get our edge to know whether or not this thing is going to roll over and come back down? And should we be loading up into the weekend on bearish positions to take advantage of what we think would be a move lower Monday, right, for those of us kind of trading that tight a time frame? Or, what's the probability of the market actually moving up from here to the next key resistance, which would be up here around 4,300. And then the market forecast is going to be our friend here. So let me show you why today if things hold, I'm more bullish about next week. First, and actually before we do this, let me show you how to set this up in the TD Ameritrade platform, because I think it's important that you know how to go grab this stuff. Okay.
Sounds good. Can I ask a quick question too?
What's that?
Can I ask a quick question too?
Yep, so absolutely.
I'm confused how none of these like momentum lines or none of these oscillators have gone below zero. Is this saying the price has always been increasing in some sort of way, even when, I feel like recently price would have started decelerating, if anything?
Yep. So again, the 0 to 100 is it is an oscillator that you could think of as in percentage terms, I guess, is the way to speak of it. So all oscillators are measured 0 to 100, and the closer to 100 we get, the more bullish we are, because the greater the rate of change is. Okay, and the lower we are, the less we're accelerating, and in fact could be decelerating. So think of things as close to zero, depending upon the direction of the oscillator. Closer to zero is really slow to negative acceleration. Okay. And the closer we are to 100, the more positive and closer we are to major acceleration. Does that make sense?
Yeah, I got it. That makes sense.
So think of it as a scale. So the closer we get to zero, the more bearish we are. Mm-hmm. The closer we get to 100, the more bullish we are. However, the closer we get to the extremes in the market, the more increased the probabilities are that the coming days will be less extreme, meaning these things always tend to revert. So what's ironic is that taking over on downs here on your one line with, the 1 yard line with this green line, while there's a much bigger risk that things won't work out because we're at the kind of near the low point in our 0 to 100 range. Right. It offers the most upside, right? Because if the line were to keep rising from here, we're going to make the most money if we get into trades when the intermediate time frame accelerator is at a low point, right? Where it's just beginning its acceleration. It means that it could be forecasting quite a big move in price, but that doesn't always happen. Sometimes these green line moves stall out. And although you're not seeing it on this chart, I could probably point to any one of a number of charts and find an example where, you think the green line is just about to get going, and then it rolls over and comes back down. And you can see the implication here, right? If you just follow this green line and you're really excited about the reversal here of the green line, and you're, getting into a trade on a signal, and you enter, and then lo and behold, the momentum stalls out, and poof, down we go. So that's kind of the trade-off. The lower the line is, the greater the reward when you pick up a trade before the accelerator shoots in the opposite direction. But ironically, when you wait until the accelerator on the intermediate time frame is up here, for example, your upside can be more limited, right? Because there's only so far this oscillator can go before it's going to roll over and change direction.
Right.
So the key is, how can we interpret the four signals? The four signals are, think of them like a symphony, and the four time frames, when they interplay together, will tell you a lot. All right. So let me just go show you how to install this thing, and then I'm going to show you some key measurements to put on these charts.
Okay.
All right? And I think I've already got the measurements done on SPX. I just want to be sure. Yeah, I do. Okay. All right. So if you're interested in setting up the charts here on TD Ameritrade, we'll come over here to Studies, and then we can do a number of different things. We can choose to edit studies, and then this will pop up here, and I'm going to actually, I'm not going to delete these, but let's pretend that none of this is here. Okay. So I hit my edit studies, and I come over here, and I want to look for the four different indicators that are part of the market forecast tool. So first thing I'm going to do is type market sentiment. Okay. Market sentiment right here. Double click on that. And if I accept that, double click, it'll just create another instance of market sentiment. I'm not going to do that, but it will appear on your chart right here. Okay. In the lower panel, market sentiment. And that's what this yellow indicator is. Okay. Now, the other three indicators all coexist in one place, and that's called the market forecast. Now, technically, this is all the market forecast, but it's just the way that TD Ameritrade organizes this. So then you can type market forecast, and you'll click on that. And if I were to click on that, market forecast will populate. I don't want to add a second instance of this, so I'm going to get rid of that. But that's what you need. You've got your market forecast and your market sentiment, both in lower panels below volume and price. Price chart is up here, and I've got actually a couple indicators up here, just so you know. If you want to replicate the cheat sheet moving average models that I've got here, you simply go over here to over here to our menu, and you'll type moving average. And you're going to see there's a ton of different options. Okay, the one to choose to replicate what I'm doing is the moving average exponential, move av exponential. See that right there?
Yep.
Okay. And you can hit the question mark right there, and it will describe, I will tell you it's not that user friendly, but a little menu will pop up describing what the indicator means, and will also give you a hyperlink to go get more information. Okay. One of the places that you can go to get, I think, much better, more trader friendly, especially new trader friendly explanations of different technical indicators, which is what all of these are. If you go to something, a website called Investopedia, you ever heard of that?
Yeah.
Investopedia, I think, does a great job of explaining technical indicators. So that's where I would go. But you'll also get a little something from TD Ameritrade that's more like a math textbook explanation. All right. Yeah. Okay. So you just what you're going to do in this case is add two examples. You'd hit two instances of moving average exponential, because I need to set up each one separately. Okay. Right. And so you double click on this twice, and you get two moving averages here, and then you can customize them. So I come over here to the little wheel to be able to customize. And so what I'm going to do is I have to choose my length, which is where, we would type in 40 to represent the long-term moving average. Displace, we're not going to worry about that. That would be only if you want to offset the moving average. You don't. So I just ignore displace. And same thing with breakout signals. I think that's kind of beyond the scope of today. So I'm going to just limit to what we need to be useful here. Okay. And then we need to give this a color. So we can choose any color. I like longer term as red And for me, shorter term is green, so that when green crosses over red to the upside, I know go. And when green crosses below red, it just means stop to me. That's just my way of doing it. But you can choose any color you want. And then you can create lines of different thickness. It's just kind of what's comfortable to you. There's 5 different thickness levels. I choose 3, thickness level 3. Okay. And so then when I'm comfortable that I've got what I want, I hit OK. And then I would work on the next oscillator, and I would again select the 10-day moving average. And I should point out one thing. How you set up the moving average here is governed by the time frame that you put on your chart. So this is telling you the 40 period moving average and the 10 period moving average, meaning 10 candles or 10 bars of trading. And then basically how you set your chart up here, you've got different time frames. You can do weekly, and the moving averages will just change the significance. So when you change the time frame that you're looking at on your chart, these candles, instead of representing a day each, are representing a week each. These moving averages just will change to a 1 week time period from a 1 day time period automatically. Okay.
Got it.
So right now what we're saying is the 10 week moving average is not only down and below the 40 week moving average, but you'll notice too that the moving average is kind of rolling away. The green shorter term moving average is rolling away from the 40 week moving average. So we've had this huge move over the summer, followed by 3 really down weeks, and now we're coming back with an up week. And so we're kind of in a no man's land right now. But I would argue that the way things are set up, because the trend is to the downside, that it's more likely, and we just don't know whether it's going to be here or here, but it's more likely the market will roll over from here. But the market forecast is telling us that we may have quite a bit of upside. There's a long way to go between 4,069 and 4,300. So remember, the green line is an intermediate forecast, and it's telling us there's a chance we make it up to the 40. It might mean that we're making up to the 4,300. We'll never know for sure. The green line can't forecast and it can't pick a number for you, but just tell you what's most likely. Okay. But we want to stay on the daily bars or the daily time frame to interpret our market forecast signals. All right. So let me just go back here to just a couple other things about setting up our studies here for the market forecast. So down here, I would recommend that you do set your market forecast colors up the way I've got them here. And the reason for that is that TD Ameritrade has some other indicators that incorporate the market forecast. And there was another charting software program called the Profit Charts, where the colors of the market forecast were fixed. I just recommend it. You don't have to do this, but if you make the and remember, the junior time frames and the intermediate time frame are going to be on the forecast, and the longest term time frame is on market sentiment. You can change the color how you want and the thickness, but I would urge you to do gold on the market sentiment, and I'd urge you to do green on the market forecast. So I'm going over here, and you'll see what I have to do is you have to pick my menu. You've got momentum, near term, and intermediate. You'll notice there's no other settings. You can't choose any settings. It's what I call a black box. It's proprietary. TD Ameritrade doesn't give the formulation away. We know it's an oscillator. So I choose a bigger width for my more important time frames. As you can probably see, I've got a 4 on the green line and a 4 on the near-term line, and only about a 1 or a 2 on the red line over here. Yeah. Momentum. Okay. So momentum is red, near-term line is blue, intermediate is green, and gold for the market sentiment line. Okay. Now, the other thing I like to do is draw some lines here, and there's at least 3 lines that are critical for you, and possibly 2 additional. Let me explain. So, of the lines that I've drawn here, the 2 absolutely most critical lines are 80 and 20. So, when we talk about a football field here, I want you to think in terms of above 80 is the red zone, the offensive red zone, and below 20, you remember you're a bull trading to try to make money as the market goes from up to down. So moving in this direction is important to you. This is often referred to, I'm calling it the red zone, but it's often referred to as the upper reversal zone. I just don't like that name because it implies that once we get up here, things are bad. And that couldn't be further from the case. Things are their most bullish when any oscillator gets up to the upper reversal zone, the 80 to 100 area. Mm-hmm. It simply means that the chances for a reversal coming soonest happen when price is most bullish. You know, the more, it's like anything else, the more extended you get, the more likely you are to have what's called mean reversion. I'm sure in your college physics or science classes or any kind of statistical analysis you've studied, you're familiar with the concept of mean reversion.
Yeah.
Yep. So the more you head in one direction, you know, even if it's a series of coin flips, right? The probability it never changes. Every time you flip a coin, you have a 50-50 chance of getting heads or tails. And that never changes, right? No matter how many times you flip the coin, it's always a 50-50 odds.
Right.
But probabilities, the more times that you flip the coin and it comes up heads, the probabilities of it continuing to come up heads get smaller and smaller, meaning not the probabilities, I'm sorry, the statistical, the not the odds, but the probabilities, meaning the statistical probabilities of a, 10 coin flips in a row coming up heads. That's really hard to do. Would you agree?
Yes.
Yep. So if you're a betting person, even though you understand that it's a 50-50 proposition for the next coin flip coming up heads, you as a trader would think we're getting closer to mean reversion because the way large number theory works is that eventually the total number of trials have to balance each other out, right? There should be 50 heads and 50 tails. Sometimes it takes a while. There have to be enough trials to get there. And so that's the principle of an oscillator. Think of an oscillator as nothing more than gauging how many winning coin tosses in a row probability tells you are likely to happen. Make sense?
That makes sense.
Yep. Okay. So, so back to these. So what we've covered so far is we've covered what the kind of roughly the time horizons are, and we've covered what each of these oscillators stand for. Right. So let's get into what's bullish and what's bearish about each one. And let's start with the longest term oscillator, the market sentiment line. When the market sentiment line is below 80, meaning outside of the upper reversal zone and pointing lower, or it's below 20, pointing in any direction, doesn't matter, it is bearish. And I'll say that again.
Yeah, one more time. Yep.
Once we drop below 80, and I'm going to just, you can't really see 80 here too well, but I'll just draw a line here, approximated, okay? So when this oscillator, there's about 80 where I've drawn it. It's a little off. But by the way, one other thing you can do is, this will not let me draw a line on this chart, I don't think. Let's see. Yeah, I got one right here. Let me see if I can do this. Give me a sec here. Let's see if I can duplicate this line. I'm going to duplicate the drawing. Yep. And then I can move it. And then here's a little trick. You can, if you use your, again, are you Mac or are you a PC?
I have a Mac.
Okay, I have a Mac too. So I've got a little trackpad here. If I put my index finger and my middle finger down at the same time to get the menu, I can edit properties here, and I can change the value of the lines that I'm drawing to exactly what I want. I'm going to put an 80 here. Okay, so there's an 80, and down here is the 20 on the market sentiment. I'm going to move this so you can see it better. Okay, so when the market sentiment line is above 80, doesn't matter what direction, it's extremely bullish. It's very bullish. There is no more bullish indicator than the market sentiment line above 80. This is on the months to years time frame. When we're operating up here, even though it doesn't last, it sometimes doesn't last that long, it means we've come a long way. Okay, so above 80, any direction, we're bullish. We're very bullish, in fact. Okay. When we start moving lower, below 80, we drop out of the upper reversal zone, we are bearish. But there's degrees of bearishness, okay? So when we drop below 80, but we're still above 50, we'd put our level of bearishness at, I like to call it on cheat sheets, neutral plus. I'm sorry, neutral minus. So it means that we're slightly bearish, but not majorly bearish, okay? So between 80 and 50, pointing lower, and the direction is as important as the location, okay?
Yep.
Below 80, above 50, pointing lower, slightly bearish, or the cheat sheet's way of describing slightly bearish is neutral minus. So it's a slightly worse than 50-50 odds. Or I should say slightly better than 50-50 odds that we're headed lower. So between 50 and 80, mildly bearish, neutral minus. When we get below 50, we are the security that this represents is kind of really in trouble. It means that we are bearish, and we're not bearish for a short period of time, because remember, this is a longer term indicator that the market is likely to, or whatever the security is that represents, when we get below 50, we're likely to stay bearish for weeks to months to even possibly a year or two. All right. And so once we got this bearish indicator here in the market, the market hit a top here in January. Would you agree we've been in a bear market ever since?
Yes.
We've gone up a few times, right? We've had some rallies, but essentially when this turned and dropped below 80, started out mildly bearish, even though we had this one run down. We still weren't that low. We gave a little bit of upside back, but we had gone up for years and years and years, about 12 years of upside. So this would still be mildly bearish. When we cross this Rubicon of 50, you'll notice that we still can gyrate in both directions, but the prevailing trend gets more bearish and things intensified to the downside once we crossed below 50 here. It didn't happen right away, and that's important, right? You're still going to have intermediate up moves within the context of an overall downtrend, and that's what can trip people up. So think of this line, this oscillator governing these peaks, right? So we can always move counter trend, but in general, the path of least resistance is lower. And the lower this oscillator drops, the more bearish we become, to the point that once we drop below 20 and stay there, it no longer matters what direction the line is traveling in. We're at our most bearish. So in summary, above 80, any direction, we're very bullish. Below 80 and above 50, we're mildly bearish or neutral minus on cheat sheets on factor 7. Mm-hmm. Below 50 but above 20, we are bearish. And that's what it'll say on cheat sheets, okay? Yeah. The path of least resistance is decidedly down, even though there can be counter trend rallies to the upside. Be prepared. Your portfolio shouldn't be aggressively bullish whenever you see an index with that kind of reading. And then below 20, any direction, we are at our most bearish, and our most bearish forecast for the longest amount of time, meaning potentially years. All right. Now we dropped into that lower reversal zone here, but we didn't collapse. We had a mean reversion rally that actually got so intense that it changed the direction of the long-term market forecast. So let's go in reverse now. Below 20, doesn't matter which direction the line is pointed in, we are very bearish. But immediately when we switch to above 20, but we're still not above 50. So between 20 and 50, pointed higher. I call that on cheat sheets neutral plus. And the way you should view it is mildly bullish. Okay, more likely to go up than down, but over the long term. But we're talking about 51% versus 49% when we're down here. All right, once we cross above 50, things are looking up, and that happened here. We have actually despite this downturn, there was so much momentum that went into this up leg in the market that it eventually got the market sentiment line above 50. And so as we were pointing lower here, this was still pointing higher and moving up, telling us that we shouldn't expect a crash to new lows or to even retest our old lows or beyond, that the path of least resistance was actually to the upside. And so we actually shouldn't be surprised that price has bounced and moved higher for the last several days, because the market forecast is just saying the path of least resistance means that it's more likely than not we don't crash. Okay. Now we could have still kept going down, and this line could have still kept going up. It does not prevent anything from happening in the intermediate time frame. It's just telling us that in the long term, we're more likely to reverse direction and to eventually resolve to the upside, as long as this line stays bullish. And that's right now where we're at. So on the longest time frame, we are bullish, but we're not yet at our most bullish. We'd have to cross above 50. Okay. In terms of trading on cheat sheets, I like to see the market at least neutral plus for me to be aggressively investing in bullish securities. So that is factor 7. I like it to at least be neutral plus. When it's neutral minus or bearish, I don't like to get into things that I'm expecting to last several weeks to several months, because I'm more likely to resolve to the downside, and I'm kind of going against the prevailing market trend. But it doesn't mean I won't take shots. I will, because my time horizon is not months to years, it's weeks to months. But I just like this thing to at least be pointing up and above 20 when I'm taking a shot. I'm actually more comfortable when we're above 50 and pointing higher. And I'm actually even more comfortable still when this longest term time horizon is above 80. And it doesn't matter what direction it is. When you're above 80, remember what I'm saying, it's a 0 to 100 scale in terms of bullishness. And when we get above 80 in the upper reversal zone, directionally, we don't care anymore. We're so close to 100 that sort of overwhelms the direction of the oscillator. Okay.
Yeah, that's interesting. So you would rather be trading when the line has just crossed up above 20 and is pointing upwards than when it has just dropped below 80 and is pointing downwards.
You got it. Absolutely right. And I would say that above 20, I'm still cautious. Above 50 is probably the sweet spot. If I were to argue the best bullish trading is as this line, now I'm talking about the long-term line, okay? Yeah. When the long-term line crosses 50, I'm really comfortable. And that's what makes this so ironic, right? Because we're in a bear market, yet the forecast oscillator is telling us, as long as your stock, you've picked good stocks that have tailwind scores that are, above 50 or above 60 preferably, and that the other oscillators in the time frame that you care about are bullish along with this, the odds say that you'll have good success. And that's what's kind of weird right now, because the market forecast, the sentiment line is telling us that not only, because we've just crossed 50, not only are we more bullish, but that there is room to run. This could last several months. Yeah. I'm just telling you what the indicator is saying. I don't feel this way at all, but I can't argue with the math of it. That's why it's a great idea to park your emotions and follow the math of this. So above 50 for any of these oscillators, but particularly this one, is really the sweet spot for bullish trading. And you'll, if you watch some of my blogs, I'll call this climbing the wall of worry, because there's so many things that can knock you off your game. But if you come back and look at this oscillator, provided it doesn't roll over and head lower, then you should feel good about initiating bullish trades, provided a lot of other things line up for you. Okay.
Got it.
All right. So I'm just going to do this to train your mind a little bit. If the market sentiment line crosses from is moving higher and then rolls over before getting to 80. Okay. So it's been moving higher, but in the last trading day, price has been a little weak, and it's rolled over and pointing lower. We'll call it at 77 and pointing lower.
Yeah.
What's your posture in the long term, the market sentiment line? 77 and pointed lower.
So that would be neutral minus, so slightly bearish.
Correct.
Yeah.
Yep. Okay. Now we've just crossed below 50, but we're at 47, and the market sentiment oscillator, here's an example, curled higher.
Then we would
finish at, we'll call it, it was at 30, now it's at 39. What are we?
Neutral plus, right?
Correct. Very good. Yep. You got it. Now, obviously, this was short-lived, right? This didn't pan out. So just remember, this is not perfect, but it gets more perfect when more other things line up in your favor. And that's why I'm going to move to the next layer on the market forecast. Okay.
Got it.
Okay. So weeks to months, you now understand the different segments and what those cheat sheet readings in factor 7 mean. Okay. And so the nice thing to do is having this on your, even if you're going to use, Robinhood to do your trading, just having this up on your practice account. You have the cheat sheet indicator, you got the, you got the oscillators. It'll make you feel good about what you're seeing.
Yeah. Okay.
So the green line is my time frame. This is the one I place the most attention in to. So, it's going to be exactly like the market sentiment line, but just on a different time scale. So again, I'm going to ask you to tell me. I'm going to point to some different places where this green line is over time here. And you just tell me what your intermediate market posture is, okay? Let's start here, and I'll give you the number. By the way, I'll show you where to get the number. So you can actually point to any candle on any trading day. And if you look at this row of indicators, it'll tell you what the day's closing value was for the 3 lines in the market forecast. I'll do the first one for you. So I'm pointing, I'm pointing on the green line here. I can point on the green line, but I'm actually going to point on the day. So I'm pointing on, it looks like March 24th, and the green line indicates 77, and the near-term line indicates 64, and the momentum line indicates 0.32. Okay. So you click on any candle, you'll be able to know what the market sentiment reading was for that day. Okay.
Got it.
By looking over here. Now, when you don't click on a candle and just take your cursor away from the chart, it's going to give you the current status. So right now, for example, the momentum line is rolled over. It's at 66.95. The near-term line's at 97. That's very significant. And the intermediate line's at 19.88. Because that momentum line rolled over, it brought us back down below 20. So you see how these time frames kind of interplay with one another. The momentum reversing, just rolling over here, killed the intermediate line. We were breaking out of our end zone there, and on the 1 yard line with possession, but we've fallen back to 19.86. So that's why it's really important to wait till near the closing bell to get your market forecast assessment. Okay. All right. So I'm just going to point out a few places on the green line here. You tell me where we are, and I'll just mention that we're below 50 and pointing up here.
Below 50 and pointing up, neutral plus.
Correct. Or mildly bearish, a bit bullish. Yes.
Yeah.
Very good. All right. Let me go right here.
So below 20, that's just very bearish.
Very bearish, correct? How about up here?
That's
I'll tell you, we're 94 pointed lower.
Still just very bullish, right?
Very bullish. Doesn't matter what the direction is.
Yeah.
Okay. One more. 77 pointing lower, just broke below 80.
That's slightly bearish.
Good. You got it. Okay. So now the next thing to pay attention to is these are 2 senior time frame oscillators, meaning they're measuring acceleration of price in 2 different time frames. And when they both agree, there's really good wind at your back. Why is that? Well, first of all, the green line as an intermediate forecast is sort of giving you the way the wind is blowing in the weeks to a couple of months time frame. And the market sentiment line is giving you that same reading in the couple of months to a couple of years time frame, right? But when both are at least neutral plus, or perhaps at different stages of bullishness, they're both in agreement. They're both at least saying the odds are better in the time frame that I'm covering that price will be moving higher, later into my cycle, my weeks to months or my months to years cycle. Make sense?
Right. You say, so when the green line and the market sentiment line are...
Yep, green line and market sentiment line, when they're lining up, it's more powerful. It's synergistic. I'm sure that, your drug and alcohol education in college tells you that, yeah, it's okay to have a few beers. You might get a little drunk. It's not going to be life threatening. But if you decide to mix painkillers, like after surgery, if you had a couple of beers and some painkillers, my guess is you wouldn't do that, I know, but the doctors would warn you against that, right? Because it would have a synergistic effect, and that a synergistic sedative effect. And so think of the market forecast oscillators in a similar fashion, especially the two senior time frame oscillators. When both are kind of in agreement at different stages of bearishness, it means that there's a better chance that the market is going to go down in your time frame, and try not to bet against that. Okay.
Got it.
Moving forward, the near term time frame and the momentum time frame, we can, but I don't generally subdivide them that way. Okay. What matters most with these time frames is the extremes. When these time frames move to a bullish extreme, when the senior time frames are bullish, that's a very powerful signal. Usually that means that price is breaking out or reversing. So I'll say it again. Yep. Above 80 and below 20 is significant for the blue line, but generally speaking, in between 80 and 20, less significant in terms of the time frame that I care about, my intermediate time frame. Now, if you were a swing trader, which is a completely different system than what Cheat Sheets is dealing with, there might be a different story. I'm just not an expert enough to share it with you because I haven't traded that enough. But for the purposes of intermediate trend trading, where you're putting something on and you hope it will go up in price, well, you're doing more than hope, right? You're planning for it to go up in price over the next several weeks to potentially several months. Then when we're sloshing around between the two extremes, we don't care that much. We tend to take action when that blue line gets above 80 or below 20. And I'll explain in more specificity in just a minute, okay?
Okay.
The red line is the same thing, but even more extreme, okay? So whereas we care about breaches of 80 and breaches of 20 with the blue line, with the red line, breaches of 90 or especially 95 or of 10 and 5 to the downside are what we're most interested in, okay? So slightly different bars. We very much care about the stage for those, the gold line and the green line, but we care more about extremes, and the extremes for the blue line, above and below 20, extremes for the red line, above and below 90 and 10, or 95 and 5.
Got it.
Okay. And this is where we start getting into some signals. So let's take, since we're just about out of time, we're going to do one signal to give you an idea of how to trade it. And it's probably the signal that comes up the most on cheat sheets. It's called the buy the dip signal. Okay. So for a buy the dip signal, we definitely need to have the green market forecast line in a bullish posture. So the green intermediate time frame needs to be in a bullish posture that is neutral plus or better, okay? The signal is more valuable when it is bullish or better. And in fact, cheat sheets, I've got it programmed so unless this green line is operating above 50, I don't allow buy the dip signals to fire, although they would be valid signals if I did. Okay. If I didn't have that restriction on there. Just want to let you know that. I just believe so much in the idea of green line trending up and above 50. That is a minimum requirement for a buy the dip. So you will see on factor 7, factor 8, I'm sorry. Factor 8, the intermediate market forecast oscillator needs to be bullish or very bullish for a buy the dip signal to materialize.
Okay. So on your cheat sheets, you won't have a buy the dip unless it's above 50.
Right. Yep. But I will tell you, it is a valid signal technically if we're above 20. I just think that it doesn't work out very often. And so I've engineered it out of cheat sheets. Okay. Because I want my cheat sheets clients to win.
I like it.
So that's a personal viewpoint. Some other traders would tell you, no, you can do a buy the dip as if the market is trending and we're, the intermediate forecast oscillator is above 20 and below 50, provided it's pointed up. and you get the other things that go into a buy the dip signal, which I'm going to explain, they're okay with it. For me, got to be above 50. Okay. So bullish or very bullish for the green line, factor 8. All right.
Got it.
Factor 7, again, you will actually see cheat sheets operate irrespective of this factor, okay? Because with buy the dip, you're entering a trend that's already established and you're creating a stop loss, which we'll get into next time. So I don't build this into cheat sheets, but I would highly recommend any cheat sheet user require, before taking a buy the dip signal, that the gold line is at least neutral plus. You do not want a bearish signal with the gold line if possible. However, the buy the dip signal will fire if the gold line is mildly bearish, for example. Okay. So while cheat sheets is disconnected from the gold line for the buy the dip signal, I would say neutral plus or better. So in other words, you do not want to see any kind of red in factor 7. No neutral minus, no bearish, no very bearish. Got it?
Got it.
So bullish or better on green, neutral plus or better on gold, or to say it another way, factor 8 bullish, factor 7 neutral plus or better. Those are 2 preconditions for a buy the dip signal. So then what is the trigger? 2 things. This blue line, by the way, buy the dip means exactly that. It means we're going up in price. I'm going to actually expand this chart out here. We'll be done here in about 10 minutes. Okay. Maybe 6 minutes.
I'm good.
Yeah. Okay. All right. So let's pretend we're right here. Let's see. Where do we have a buy the dip signal? Yeah, we had one. Yeah, this is kind of late in the game. I'm trying to give you a better example. The problem is we got a bear market in front of us, right? Let me go back in time or let me pick something else. T-Mobile. I'm making a lot of money on T-Mobile right now. TMUS. That is in an uptrend. So I'm going to just dial up TMUS. Okay, see how it's in an uptrend? This has actually showed you exactly where I bought it. And I've been making some good money. But we're a little late in the trend. You'll notice that it's no longer a good time to buy. Why? Because we're at 67 on the green line right now. Why isn't it a good time to enter a T-Mobile signal?
Because it's not in a bullish posture.
Right. We're in a neutral minus posture on the intermediate forecast.
Yep.
Even though we're in a very bullish posture on market sentiment where we're above 80, but this is saying that there's more likelihood that we'd retrace, even though we will more than likely not resolve to the upside. I've got a stop loss here, so I'm okay. I've been in this trade since here, so I've made my money, right? I've gone from 130 to 145, making a nice 10, 12% gain. So I'm happy, and I'll be out if this thing falls here. But you don't want to initiate a trade here. All right, but let's go back to where we were bullish. All right, so the market sentiment line turned in direction. Looks like we were. I can't tell what that price was the day I bought it. This is the day right here, 622. I might have even jumped the gun here. It looks like the sentiment line hadn't curled up yet, but it was trading at 54. But it looks to me, just eyeballing it looks like it was still sliding down. So that's kind of bad on me, but it worked out. But notice let's pretend I was really close. So we'll pretend this was rolling up because I'd way prefer my trades to be with this line rolling up. And you'll see that this line was rolling up, right? So both of these lines rolling up. And here's where the buy the dip comes in. The blue line triggers the buy the dip. The blue line pulls back below 50, but stays above 20. That is an absolute requirement. It cannot get any lower than 20 to be a valid buy the dip signal. You want this to be what's called a light volume pullback. That's where it just kind of goes back down for a couple of days before continuing higher. Make sense?
Got it. So you actually want it to be going down, but not below 20.
That's right. So what you're doing is you're capturing a dip in price, but you want the dip in price to be, hey, we're losing a little bit of velocity, but we're not in free fall. That's what we want the blue line to tell us. Okay. Yeah. The other thing we want the red line to tell us is that we need to stay above 5. Okay. Below 5, we are worried that more sellers have come in at the end of the day that are creating such pressure that the stock could follow through to the downside. So it doesn't matter where the momentum line is. It just needs to be above 5. Okay.
Got it.
So sentiment line, neutral plus or better. Intermediate line, bullish or better. Blue line and price pulling back, but pulling back in a controlled, light and fluffy way. So it's like the parachute is opening and we're going to be able to hit the ground with our 2 feet without breaking our legs. Okay. Meaning we're getting into price. We're getting into a dip that we expect to reverse. And usually by the dip signal, when it materializes, price has already pulled down and is actually reversing. Okay. So below 50, but above 20. And the red line just simply has to not be a disaster. Above 5, preferably above 10, I'd say, just for a little margin of safety. On cheat sheets, when the red line gets below 10, you'll see an indicator called heads up. Okay. So it's green otherwise, right? It'll be neutral 10 to 90, or it'll say very bullish above 90. So I'm talking about factor 1 now.
Yep.
Factor 1 will as long as it reads green, it's good. If it reads red, heads up, it's a little bit more risky because it could mean that we've dipped below 10 today and we could dip below 5 tomorrow. So just 10 is a heads up, but 5 is the line in the sand number. Okay.
Got it.
And then the blue line is even more basic. Between 10 and 90, we're fine. I'm sorry, between 20 and 50, we're fine. Below 20, we're not.
Right.
Okay. So that's a buy the dip signal. So that's how those market, the 2 junior time frames are telling you, yeah, we're pulling back, but it's not a disaster. Blue line staying above 20, red line staying above 5. But the other 2 lines are telling you, even though we're pulling back, the direction of the intermediate and long-term trends of the market are solid. It's a good chance for you to join this trend already in progress.
Right. That makes sense. And for the buy the dip, the intermediate line, neutral plus is all right, right?
Neutral plus is all right on the intermediate line, but remember, it won't fire. For cheat sheets,
right.
I force it to be 50 or higher, so you'll only get a buy the dip if the security reads 50 or higher.
Got it.
Okay. But that's my rule. In general, as long as the market sentiment line is also neutral plus or better, if you're getting a neutral plus reading on the green line, meaning it's above 20 and moving higher, technically it's an okay signal, but just remember it's a much weaker, lower probability signal, more prone to failure. That's the downside. The upside is that if it works out, it's going to run longer and give you a better return.
Right.
So the market is always about plussing and minusing things, right? And so you as a trader have to be comfortable with more losses as a percentage of attempts when you're making your bets at a more high risk reading. And then you have the opposite problem, which is if you wait too long, if you wait for the market intermediate line after a big run up, right? And you decide to wait until it's well above 80 to make your buy the dip. This actually turned out not to be a good buy the dip signal, but let's suppose you bought up here expecting to continue to run, right? You were pissed. You waited too long, right? So the opposite is true, is that when you wait for every line to be as bullish as possible, which is what happened up here, right? Red, green, and blue line were all above 80, maybe even above 90 here. Now you could argue the market sentiment line was telling you don't do it because it was rolling lower, but pretend it wasn't for the most part. You can see the problem is you've waited too long. There's nothing left. There's nothing left in the trade. So that's why the sweet spot is above 50. That balances the risk between a lower win rate and maximum returns. That's why I like it. But if as long as you're okay with losing more on more occasions than winning, but making 3 times as much money when you win than when you lose, your mind might be wired more psychologically as a trader to start your bets earlier.
Yeah.
And that's what you're going to have to find out through trading. And I highly recommend paper trading so that you take 100 trades. I'll teach you the next time we get together, I'll teach you how to manage a trade. Okay. We've basically given you the buy the dip entry signal and I'll show you how to manage that next time.
Okay.
So I think that was a lot to take in, and you've got this recording that you can use as sort of your cheat sheet.
Yeah. Awesome. Sounds
All
good.
right, now go practice. I know you got a full course load and you're an athlete, but even if it's just 10 minutes a day to look at the market, to check a buy the dip signal and cheat sheets, write down where you get into the trade, and I'll teach you how to place a stop loss on paper when we get together next. And let's see how you do. Keep track of your trades. Really important. 10 minutes a day.
Sounds good. I'm going to start.
All right, buddy.
I'm going to start soon.
Very good. Look forward to chatting. Just get in touch with me when you're ready to have the next lesson. I know you're going to get busy, but Fridays are a good day for me.
Yeah, same with me.
All right, bud.
Awesome.
Take care.